Okay, good morning everyone. This is the brief for the 16th of Feb 2018. What we're going to be doing today is we're talking a little bit about the price action we've seen post the two sell-offs that we saw last week, and how the market's responding and some of the correlations which are synergistic, antagonistic towards seeing if this move is further sustainable. That's going to be us looking into the dollar, commodity prices, yields, etc. We're then going to talk a little bit about Bitcoin because a couple interesting things to note. I kind of finally am convinced that it has a correlation with the market, and what triggered this as well is, I think, again, to do with the equity sell-off. So we'll discuss that a little bit more in detail, look at the charts to provide some evidence. Then we'll look at the data calendar ahead, and we'll then carry on with the session from there. So just to start, let's have a look at the charts and see what's been happening. I think the main story has been the dollar weakness. So where can we see that? We can see that in the currency pairs particularly. Maybe not daily chart. You can see that we see after this inflation number we saw on the 14th, which was the Wednesday where we saw that initial bid go through the dollar only to be fully reversed. We've actually seen the dollar continue to weaken after that powerful move higher, consolidating against sterling, but really grinding higher nonetheless. This was also repeated in the Euro USD. Which I just get the charts up here. Euro USD, once again, similar picture here. Dollar going bid on the back of the inflation numbers, a higher end of market expectations, but then fully reversing. The dollar is now continuing to weaken. This is filtered through into the other markets, as we guys are pretty familiar with here. Gold is quite elevated given the fact the dollar has been weakening as well. Gold, however, is trading at quite an interesting price. Will has just told me this morning he expects it to be trading at 1400 by the end of the month, which is not the bravest call, as I was telling him. Knowing him, I'd expect him to be making a call of 1450, 1500. So very interesting prices being traded here, just dollar weakness. But coming up to the top of the 2017 prices, mid 2016 prices here as well. So keeping an eye on gold is quite an interesting move. As an example, it'll be giving you the dollar weakness trade, as well as a bit of risk aversion in the market as well. So all eyes on that. Now, given the fact that we've seen dollar weakness and gold going bid, another correlated market which has been sort of making headline news has been the dollar yen, which has really been taking quite a bit of pressure recently. This dollar weakness and yen strength has been driving the dollar yen down, and if we just flick across, we can see Bank of Japan's Kuroda warns against premature plans of stimulus exit. So this is him. This is in itself quite a dovish stance, but this is what Kuroda is famous for in terms of providing stimulus to try to keep Japan afloat, try to keep it out of deflation and stimulate the economy. So I don't think this in any way will look to weaken the yen. More of a dollar play coming into here, as well as the safe haven flow we were seeing, given the fact that the equity markets have been selling off. So currencies are still interesting to be keeping an eye on. The dollar index continues to weaken. Dollar index investing. And this is basically a one-way trade. We've discussed this quite a bit in detail as the days have gone on. But as you can see, the dollar continues to weaken. We're just testing quite a key support level here. If this breaks, then no doubt we'll see continued selling in the dollar in the days and weeks ahead. So breaking back into this sort of range, we were seeing the top end of this range from 2007 to 2010. But really no rejection off here. We bounced a little bit, reclaiming that 90 handle, and then sort of coming under pressure once again now. This is a tradable product, so it does behave technically. If we do see technical levels being tested, it oftentimes can provide support. You can see this is quite evident when we were trapped in a range here. When we were coming around this 93 mark, we used to see the market look to reverse. So dollar weakness is still the story, and that brings me to my next talking point, which is the equity market. So having a look at the S&P 500, putting on a daily chart with a 50-day moving average. It is breached there, tested there for that classic, and now has reclaimed that there's quite a bullish phase in the US equity market. So we just transition here. Looking at the Bloomberg markets, this is what they were looking at. Stock market continues in Asia, dollar declines, market wrap. So S&P 500, 5 best days since 2011. So after having had this worst week in multi years, we're now seeing the 5 best days in over 7 years come into the S&P 500. So when I see articles like this, buying the dip, that old Wall Street favorite, comes under scrutiny, I sort of disagree. I think, yes, if you're a long-term investor, medium-term investor, buying the dip is a bit dangerous. If you're an asset manager who can't touch their portfolios for maybe a week or a quarter, then this would be quite risky to be buying the dip. But I have absolutely no hesitation to say keep buying the dip. As a trader, as an intraday trader or short-term trading, first of all, you can always get out. Second of all, well, what sort of market conditions are we in now? And when were the last times we saw these market conditions? Well, inflation creeping higher, but otherwise still relatively low. Dollar weakening, commodity prices higher, global growth story positive. Well, this was in December. Okay, so in December we were trading around here, and at the beginning of January we had those relatively positive earning numbers. Sorry. So we're fine where we are, and actually we have no reason not to continue to track higher. And if the dollar continues to weaken, we have more reason for it to continue to go higher and higher and higher. So looking to buy the dip makes sense. In terms of some of the opportunities this week, one of the best ones was really, if anyone was trading the inflation numbers, it was a difficult data set to be trading, because we saw the dollar immediately strengthen on the back of it as we saw the inflation numbers come out on the higher end of expectations, but then only for the market to fully reverse this and then just realize that, well, why was the dollar going bid? Why was the equity market coming under pressure? This was because the market was concerned that we might see a more hawkish hiking cycle. Now, this more hawkish hiking cycle would have been, what, 4 hikes? I think that would have been the most hawkish situation that the market was pricing in. So materially, not really the end of the world, but we were looking to see if these inflation figures showed any sign of this inflation picking up. Now, given the fact that we're on the top end of expectations as opposed to a substantial beat on either cases, brings us back to base case, which is 3 rate hikes. 3 rate hikes was already priced in the market. So first of all, I think the move was, okay, this is higher than expected inflation. Everyone in the whole world was so pent up about this trade that they see the higher than expected inflation, sell equities, it goes down. Everyone who was a little bit more rational, taking a moment to breathe and think, okay, what are we trading when we're trading the financial markets? Generally speaking, we're trading rate hike expectations, whether it's from the Fed, the Bank of England, or the ECB. Does this change anything? No. In fact, it takes away those outside bets that we're going to see that 4th rate hike. Therefore, 3 rate hikes priced into the market. No need to be concerned. Anyone who had the outside bets for unwind their position, and equities continue to rally. And the long was really here. And so when was the last time we were trading in similar environments? December, January, which is this long run here. We found evidence after that inflation numbers that what was true then is still true now. Therefore, a long, and I have no doubt, well, I'm fairly confident the equity market is going to once again return to the all-time highs in the forthcoming weeks. Now, what percentage move are we looking at for a run to the all-time highs? About 5%. So, I'd say mid-March, possibly. Mid-March, before the next inflation numbers, we'll be trading at the all-time highs, which is not the bravest call in the world. But next is going to be, can we edge above the all-time highs, and this is then going to be the deciding factor. Can we make a push past the all-time highs and close past the all-time highs? The market was so comfortable to keep making new highs day in, day out throughout the whole of 2017 that I don't even think Squawk, Bloomberg, anybody covered the majority of the all-time highs in the stock market. So it'll be very, very interesting to see if we can get above here and close above this price point to see if this equity bull run is going to continue. This brings us, I imagine in the next month or so we'll get up there, or the next 2 to 3 weeks. It brings us into March, which is where Deutsche Bank has said that this growing economy, this increase in GDP, statistically takes 18 months for inflation to filter through. That 18 months starts in March, so it'll be, I do not believe this volatility is over by any means. I think, yes, we've got a calm before the next storm, which is March, April time, where statistically the growth story is going to become more pronounced, and we're going to see inflationary fears once again come into the market. And, you know, I think a logical target is the all-time high, but that doesn't mean that I think we're in for another year like 2017. I think volatility is absolutely going to be there. But it's about planning as opposed to expecting every day to see massive drops in the equity market. Right now, we have higher commodity prices. If you have a look at oil, which has been a huge benefactor of this weakening dollar and rebound in equity markets. The commodity prices are obviously risk assets growing or becoming more expensive or increasing in value as global growth starts to pick up. And second to that, the cheaper dollar as well being very positive for the oil market. Medium-term outlook, I mean, this collapsed along with the commodity prices plus the increase in US output production. We saw lesser builds on Wednesday driving the price higher, and we've managed to sort of stay quite elevated here. So let's have a look at where we're trading. Next real technical price point here is that resistance, which is just sort of these levels here. If we can get through there, that also couples with the R1. So actually, technically, it looks like a really good point if your sort of view on the market is to go short. I've got some key levels coming up, and I think there's solid arguments to be getting short this market. So looking at this 61.90 stop above R1, good protection, risk versus reward is good on this trade. There's good reason to be going short, which is still we have some risk aversion in the market. We've also got the increase in US output production, so oversupply argument still there. On the other hand, you've also got good reasons to be getting long this market. Well, first of all, we had the lesser draws, allowing the market to go higher. Short-term trend and sentiment is higher. Definitely some profit taking from this fall that we've seen, a reclaim of the handle, plus equity markets in essence going up, risk on. So you can argue both the long and the short in this situation. Now, where would I be looking to get in short? Sorry, I already spoke about the short. Where would I be looking to get in long? We have a sort of a double top here, which has been traded through a few times at $60.50, being an interesting price point. After that, pivot I would sort of leave alone. We've had some resistance, some support there, a bit of support here, but it doesn't look too appealing. It's, for me, it really is this S1 level, which is sitting exactly on the $60 handle as well. We haven't had the cleanest tests before, but I think if we came down to S1, first of all, we would have fallen a substantial amount, almost $1.50, which is by no means impossible for oil. So we would have been falling for quite a bit of time, and the handle coupled with the fact that we're on the S1 level would probably find some good support. Stop would generally need to be a bit wide on this trade, or taking yesterday's low as an entry point and putting your stop loss behind here could also work pretty well. So oil is going to be an interesting market, but I feel if we continue to see equities rally, dollar weaken, then going long, oil market is going to be the preferred trade. So that's the commodity space. I wanted to talk a little bit further on 2 or 3 more talking points. There was all this turmoil in the market about this impending 3% yield in the US 10-year. If I just transition and just have a look at where the US 10-year is trading, this correlation is, the market has discounted this. They don't seem, for the moment, too concerned with this. About a week ago, when the market was on edge, when the market was looking at the inflation pressures, the fact that the Fed may need to hike 3 times, this was far more interesting to watch, because we saw as soon as yields were rising just slightly, the equity market would come under pressure. But monitoring this over the past couple of days, this has become less pronounced for sure. One thing I would keep an eye on is have a look. Let me just get the chart right. Okay, just have a look at this chart. Well, you don't have to actually have a look at the chart. Go to trading economics, go to markets, go to bonds, major 10 years, so these are your benchmarks, and you've got the US here. Keep an eye on that figure. When it gets to 3%, I'm sure we'll see some interest from market participants regarding the fact that the trades yield is at 3%, but given that inflation hasn't spiraled out of control and therefore isn't a need to be too concerned, I think it takes a sting out of this yield story. Okay, so we've spoken about the US equity market, the commodity market, the FX market. I wanted to touch upon the Bitcoin just shortly. Bitcoin, obviously a very infantile market, quite young, was really just trying to find its feet on the futures market for quite some time, which was quite interesting to watch. But finally, I think it was this volatility we saw on Monday that sparked this correlation between what I'm seeing is the Dow Jones or US equities and Bitcoin. And this now makes sense to me. I think if the US equity market sold off on the back of risk off, that means market participants aren't willing to take on risk, worried about a downturn in economic conditions. A lot of people involved in the Bitcoin industry, people involved which have led to the Bitcoin being priced where it was, were largely retail. So if these individuals are not feeling confident in the economy, if investors aren't feeling confident in the economy, then there's no way that we should expect normal individuals who are not, investment professionals to feel comfortable holding Bitcoin. So as we've seen safe havens fall off last week, we've definitely seen people look to short Bitcoin as well, and Bitcoin prices have gone down because it is on the ultra speculative side of the market. If US equities are speculative, well then Bitcoin is heavily speculative and definitely a risk asset. So I think this was the flashpoint and the trigger point to see a correlation form, and you can see US equity markets falling quite dramatically here, and this also making Bitcoin come under pressure. And then you can see when US equity markets bounce, we see Bitcoin bounce, and US equity markets sell off again. Bitcoin looks a little bit heavy. Then after the rally, now we're seeing them both move together, rising relatively sharply. Bitcoin now at about 10,000. So psychological handle there for the Bitcoin currency. So, I mean, this is becoming, the correlation between risk assets such as equity and Bitcoin is becoming more pronounced and something to be keeping an eye on. By no means is this any of these heavily correlated enough for you to be able to get a wink that one's moving, therefore the other one's going to move. But it's good to see this market starting to mature and find its correlations and sort of dependencies, albeit rather predictable given the fact that it is just another risk asset. Just having a look at these analog charts, I wanted to just show you the difference that we're seeing between the US equity market as well as the European equity market. This is led sort of by 2 things. This chart looks a little bit messy, but what I've done is I've put 4 charts here. The top 2 over here is the Dow Jones and the S&P. As 2 US equity markets, high degree of correlation, and they have been performing pretty well together given the fact that the dollar is quite weak. This dollar weakness is causing the Euro-USD pair to go higher, which is obviously strengthening the euro versus the dollar. This has negative implications for the European stock market. So you can see DAX and Euro stocks down here at the bottom. Both still on the front foot, but definitely underperforming compared to the US equity market. So you've got that FX play coming into it, dollar weakness raising the value of euro against the dollar. Second to this, Ray Dalio has made it very public that he's increased his bets against the European equity market by $18 billion, I believe. $18 billion, one of the largest hedge funds, well, the largest hedge fund in the world, turning bearish on equity. I have no doubt dampen people's appetite to buy these risk assets when you've got the US equity market, which is trading obviously still at a massive discount, with no public massive short bets against it. So it's going to be interesting to see how this develops. You know, if Will has been talking about the Principles book by Ray Dalio, which is a great book, but you can sort of see, if anybody does read that book, and I would encourage you to, it's a good book, you can see that Ray Dalio, he actually is, most fund managers are, is quite smart and very strategic in the way that he places his bets, and he has been right while the market has been wrong on a number of occasions. Financial crisis, EU debt crisis being the last two recent ones. So he's called it right twice. And now while everyone's betting on Europe, he's betting against Europe, which is an opportunistic time from him if he's right. So, I mean, this is not intraday trading, so he's not expecting it to plummet within a minute or two, but he definitely be interesting to see if this equity market can catch a bid, given the fact that DAX has traded around the all-time highs in similar fashion to the US equity market. So if US equity markets are looking to go test their all-time highs, it'll be interesting to see where the DAX is trading at that point. Is this stronger euro and the bet against the European equity market weighing on sentiment and the ability for the equity market to continue to rally? Okay, so you know, at the moment moving together, but US equity market definitely outperforming. So that about covers all the talking points. Let me quickly have a look at the calendar ahead. Is this the calendar ahead? What day? Okay, trading.
So I mean, I just want to find.
Okay, so 9:30, we have UK retail sales. This is obviously a precursor to inflation as well as a gauge of sentiment. If retail sales are high, this means that people are bullish on, or they're feeling strong of the economy. They have enough money to spend. This will increase demand and therefore lead to inflation. Plus, it will also mean that people are willing to spend. If people are willing to spend, this would be quite strong for our economy. So this is absolutely tier one data. You got your year-on-year figure coming in, which is which is not X, sorry. This is this takes seasonality out. You're comparing last January demand compared to the January before that, while month on month is comparing December to January. So there's obviously seasonal factors that come into it. But retail sales have been on the decline for the past 12 months or so, steady decline here. So sentiment is going down, having implications on the economy. This is, yeah, so an expectation. Is that right? Consensus for a reading of 2.6%. Okay, so coming in for the January readings here, expecting 2.6. So quite a sharp bounce here in retail sales expected. 2.6 expected on the year-on-year reading. Okay, wow. Last month we had a 3% expectation, got a 1.5 stars, obviously pretty bad. Now 2.6% expected. Okay, so that'll put us right up at the top of this sort of range that we've seen for the past year. We got some outliers at 3.3%. I think seasonality does come into it. Looking at 12 months ago, we had 2.1%, which was still a relatively healthy number. So we're expecting the UK economy to have done well in terms of its sales. So any beat on that, if we price that in, we're looking at a number of about 3%, I'd say, to see sterling really start to see appreciation. But given where sterling is trading on the back of this dollar weakness, we may be better positioned for sterling weakness. Now, in which situation would we see sterling weakness? I'd say if we can drop down to 2.1, 2.2 levels, this would then result in sterling coming under pressure. So those would be your two ranges. Looking at your month-on-month figures, consensus is for 0.5. Having a look at the chart here, A reading above 1% would initiate some selling strength, while a reading sub minus 0.8 would result in a bit of weakness coming into that market for sure. As always, need to be keeping an eye on your ex-fuel year on year, month on month. Obviously, fuel prices are pegged to price of oil, and the price of oil can be quite volatile, as we've seen. We've been below 60 and above 60 all within actually one day or a 24-hour period. So this ex-fuel is going to be quite an important number to keep an eye on. So we'll be doing a full rundown of that leading up to the data set in about 20 minutes. But that's your main data coming in for Europe, the European session. Then looking at the data calendar ahead, we have building permits, export prices, housing starts, import prices. Nothing too significant at 1:30, or largely tier 2 data. We have some Canadian data coming in here as well. Manufacturing sales month on month, foreign security purchases, not sure. Manufacturing sales month on month, this will be an interesting data set for anybody trading the loonie. Alex C, if you're in this room, hopefully you've done your revision on how to trade the loonie. You're going to be a little bit more careful. If you're trading the loonie, guys, get in and out nice and quick. It has a tendency to complete its move very quickly before sort of just stagnating. The next data set, 3 o'clock, we have Michigan consumer sentiment preliminary numbers, so very important, particularly for the equity market. I think given sort of the volatility we've seen, this sort of soft data is going to be quite key to the recovery of the US equity market. I think this is almost good news is good news, and bad news might even be good news. People will shrug it off, shrug off the bad news maybe in this situation, while good news will really be a factor which drives the equity market higher. So important numbers to keep an eye on in terms of importance. It's your consumer sentiment preliminary. Just having a look at the chart here. First, let's put it on to maximum time frames. So you can see post-financial crisis steadily rising, really up here at some of the best readings we've seen historically. Only in maybe the 90s have we traded above there, which was that euphoric period where money was freely available and everybody had jobs. But actually taking a hit here. So after peaking out in October, we have come under a bit of pressure. Still very much within the 12-month range, nothing to be concerned of. But if we do start to print down numbers, could this be that US sentiment is now starting to dry up? Maybe the case. Maybe also influenced by this downtick in the equity space that we've seen, because doom and gloom headlines being all over the news are definitely not the best situation. So consensus reading for today, market expectation is for 95.5. So 95.5 will put us, basically flat for the past 2 months. This will give us a 3-month average of 95.5 basically. A beat on that, I think you'd be coming up, would be seen as a positive for both the dollar and equity. And now I have been saying this, I've been talking about the equity market while looking at tier 1 data, which is something we quite strongly stop people from doing. But I think the equity market will respond relatively well to this sort of soft data. Equity markets are driven largely by sentiment, so key sentiment data will obviously have a good influence on the pricing. But in terms of focus, still be looking at your Euro USD currency pair for sure leading into this data set. So in terms of readings, 97 or above would be bullish. If we start slipping sub 95, we get a reading of 93.4, I'd say this would be a reason for concern, and it would sort of start to confirm this downtrend in sentiment and may actually result in the equity market coming under some pressure. So in terms of data calendar, we have the UK data, and then we have quite important US data as well. So in how you're going to be looking to trade today, early in the morning, keeping your powder dry, 9:30, data comes out, trade it within 10-15 minutes, walk away from that market, and then look to plan your trades, wait for the North American crossover, 1 o'clock, get ready for the 1:30 data, which will be lesser market influence. But then 3 o'clock, right at the end of the day, you've got your next bout of volatility. So nice and early in the day, and then late in the afternoon, the middle day, guys in stage 1 and stage 2, even in stage 3, please, manage your risk quite carefully. There may be limited opportunity. So keep your stops, less to the stops and more in terms of size. Don't be taking on too much size during the mid portion of the day. In terms of opportunity, is going to be heavily weighted either on the early 9:30 or around 3 o'clock. Okay, guys. Well, thank you very much. Let me know if you have any questions. Pop them into Trading Live. Me, Sam, or Ant will be on them. I can see Sam is dealing with the Bahrainians at the moment. Okay. Thank you very much, guys. Cheers.